Fantastic to catch up with you, sir. Just walk me through how you've read this market over the last several days. The question I asked earlier this morning, if I just showed you the price action, you didn't know what had happened Tuesday night into Wednesday morning, it just looks like the Fed's come out and done a whole load of QE. It doesn't look like anything to do with politics at the moment. Rick, what's your read on things?
I think, by the way, it's been an insane week. If I ever look forward to a weekend and sleep, this would be the one. Listen, I'm not sure that the market this has been a surprising reaction to the market at all. I would say there are a couple things that were surprising. The fact that the rates market, the Treasury market, was rallying for a while, I thought was remarkable. The fact that people were buying 10-year notes at 75 basis points or lower than that, 72, 73 basis points, that was pretty amazing. Listen, I think the markets, first of all, the markets like certainty. And if you were evolving towards what is greater, a sense of greater stability, if we are evolving to a place where the election is behind us, that is a pretty significant deal. Secondly, I would say if you take a dynamic, let's say, and we're moving down the road of a Biden presidency, and let's say the Senate, which I would argue was the most surprising dynamic, ends up being Republican control. You have a dynamic that, A, you're going to get more stimulus. I think people are underestimating that now you won't get stimulus. You're going to get more stimulus, part of why I think treasuries are not that interesting. And B, you've got an economy, what today's number illustrated. Gosh, if you take the household number up over 2 million jobs, if you look at construction, construction up 85,000 jobs, retail, travel and leisure, those numbers up 270,000 jobs. Listen, I think employment, I think Michael said it right. Employment's going to be slower to come back. The economy is in better shape than people think. And the resilience of the economy, and if you have some election behind you and you don't have radical tax change and you don't have radical stimulus beyond, what the markets are willing to absorb, then, I would argue the markets aren't doing the wrong thing, Jonathan.
So what do you want to buy then, Rick? What do you want to own in the environment that you describe?
Not treasuries, and I would argue that so you think about, let's say let's start with fixed income. But I think the yielding assets are interesting and will continue to be interesting. We're going to have an environment for the next number of years, where certainly in the next year or two, where rates are going to stay low. How do I get yield? I need yield. I need yield. And so things like the credit markets are still interesting. By the way, I think emerging markets now have gotten, I think I said that on Bloomberg a couple of days ago, emerging markets are interesting. As you talked about the dollar, some moderation. I'm not sure the dollar's going to come under tremendous pressure. Emerging markets, though, you think about Asia, you think about China relationship, et cetera. I think that's interesting. And then, I've said it before, in a world that needs income, if you can get earnings yield in the equity market of a 4.5% or a free cash flow yield in the 4s, equities continue to be interesting and a bigger part of the asset allocation mix going forward. I think people continue to underestimate how powerful that is.
Well, Rick, I want to start with the international tilt to a portfolio at the moment. I want to caveat everything I say right now by saying this race has not been called. But markets are trying to anticipate. That's the nature of markets, discounting mechanism about what may or may not happen in the future. Rick, this market is thinking about a weaker dollar. Market participants are thinking about more of an international tilt into their portfolios. Off the back of what's happening politically speaking, there is a belief that a Biden White House, if indeed we do have a Biden White House, would be more constructive for China, for EM, for Europe maybe as well. Rick, does that resonate with you?
Well, some of that resonates with me. I mean, yes, better relationship potentially. Yes, I could see that. And, part of why we've added some emerging markets, I think that is durable. Listen, I think people for a long time are betting on a significantly weaker dollar. I don't think there's a lot of return generated from that trade. There are so many reasons why the dollar stays buoyant, including investment that comes into the U.S., including trade that happens in dollars. So I'm not a believer that, get ready for the big decline in the dollar. That I'm not a big fan of. And if you said to me, okay, let's think about asset allocation. Can I get some emerging market yield in the portfolio? That makes some sense. There are parts of Europe that I actually think are interesting today, and particularly some of the banks that I think have gotten interesting. I'd give you a lot of yield, quite frankly, when you think about what your potential earnings yield off of where they trade on a book value. But then I think U.S. equities, you're still the most vibrant growth dynamic. You still have the highest free cash flow generation. And so I would say U.S. equities, by the way, parts of the equity market in China, Japan, that are also pretty interesting, where you're getting Japan from a valuation point of view, China more from a growth and technology point of view. But I think you got to be really precise. I don't think there is let's get into all around the world internationally. I think you got to be precise about where your asset allocation goes relative to the opportunity set.
Well, let's work through that precision right now. You mentioned European financials, then you talked about the United States. Let's deal with Europe first and then get to the United States. European banks right now, Rick, as you know, the United Kingdom in lockdown, France, Germany, Greece joining the party that no one wants to join and go to in the last couple of days as well. Rick, why European financials right now, given the headwinds to the economy?
Only one thing, Jonathan, price matters. And if I don't think there's an explosive growth dynamic that makes a lot of sense. I just think if you can buy some of the banks at 15, 20, 30% of book value in a reasonable growth dynamic and be willing to hold it for a period of time, that is it. Is that the big core of your portfolio? I don't think so. I'd still rather own parts of where technology is going to grow in the U.S., China, et cetera. But I don't mind taking some of these European financials at a fraction of book. I mean, they've rallied. Some of them rallied quite a bit in the last week or so, just because the price is really cheap. Listen, I think growth in Europe, as you said, COVID is not going away. I think growth in Europe is still a bit challenged. There's some technology companies in Europe that are interesting. There are some consumer oriented companies that are interesting. But the core of the portfolio is going to sit U.S. I think China should be a core of the portfolio. Japan has become more interesting recently. And like I said, maybe taking a little bit more EM, particularly in the debt side, but also a bit in equity can make some sense today.
Rick, I'm not sure what you've left out. The US, parts of Asia, Europe as well. Yeah. Let's just talk about US just quickly, Rick. Final question for you. When the United States, there's been that huge debate over growth, a huge debate over value, the cyclicals. Where do you want to own in this equity market? What pocket of it?
So it's the first thing, your point about I haven't left anything out. I just want to be really clear. I think the U.S. is the most interesting opportunity. And by the way, I think equities are much more interesting. So I just want to be really clear about why I'm more favorable about those parts of the world. It's in equity form that I think is more interesting. Otherwise, okay. So what sectors? Listen, I think healthcare, managed care particularly, I think will be better than people think and is starting to get some rally around it. I think technology. I think big tech has run quite a bit. I like selling some volatility, selling some upside convexity against a technology, a big tech position. But boy, I still think software, artificial intelligence, data assimilation, technology, I still think will win. And the last couple of days, industrials or cyclicals haven't done terribly well. I would actually, I think some of that area makes some sense for a while. And I would say the one other place you can get some income is through the financials. Listen, the whole argument that people say about, gosh, now's the time to buy value. I don't even understand what that means in terms of some of the traditional businesses that are more tired. I'm not going there. I still think some of these different technology areas are going to win. Healthcare is going to win, et cetera.